Hi, Professor Condie, or I guess I can call you Scott now, right? You're not giving me A's or B's or C's anymore. So I guess Scott's okay.
Yes, yes. I had someone important say to me once, if they ever, or I said to someone important to me once, if you ever hear me ask someone to call me Dr. Condie, then something has gone terribly wrong in my life.
Well, what's funny is, so I came back from serving the LDS mission, first semester back, and you're like pretty excited to take classes, and I'd signed up for a lot, and then my guidance counselor was like, maybe you should pull back a little bit, which proved to be smart. But one of the classes I kept was your macroeconomics class. You were teaching it then.
Yeah.
I don't know if you still are, but
Yep.
I feel like honestly that was like the first class that made me realize this isn't like high school. Like this is you might not be able to pick up everything like 5 minutes after a class and just like running through notes. Like it was one of those classes where I realized, hey, I'm going to need to read like the textbook. I'm going to need to do some of these problems. It was
well, you're ahead of, if you figured that out that early, you're ahead of some students.
Well, I won't say, I mean, I had my freshman year before I left, but it was let's just say it was more business classes freshman year. So
Is that a euphemism, Matt?
I'm just saying the macro course was a little more like, oh, okay, like there's some math here. Like, it wasn't heavy math, but it was more just like, hey, this is a little different. This is a step up intellectually. So.
Well, you're speaking all the right words to me, Matt. It's making me feel good about my life choices.
Yeah, just trying to butter you up before we started asking questions here. So, but so yeah, you deal in financial markets. Maybe could you talk a little bit about like what got you interested in economics, why you decided to become a professor, get a PhD, and like what's your area of focus now?
Sure. So I got interested in economics because, so I was a poli-sci major for a little bit. I also served an LDS mission, came back. I was a poli-sci major. I don't really know why that happened. It just seemed kind of interesting. But the first semester of that major, I took an econ class. I took our principal's econ class and loved it and was like, this is great. That econ class was part of the prereqs for these poli-sci things, and I loved it. And then I actually had two kind of transformative experiences that, I mean, I already knew that I enjoyed the content in econ from that principal's class, or at least I enjoyed what I thought the content would be from that principal's class. But then I had a couple of just interesting experiences that I think some are common to other students who have been in econ. First of all, the professor for that class, Jim Curl, who's now my colleague, was he would write a letter to everybody who got a good grade in that class, and so I got one of those. And at the end of the letter, it said like, if you have any questions, please feel free to stop by. And Jim is an amazing colleague and an amazing instructor, professor. He just commands attention in this huge, like 500-person lecture. Yeah. But he's a little bit intimidating in that lecture, because there's so many people. And so I was kind of sniveling and cowering. Like I wrote down my questions and was like, I don't want to take up too much of his time. So I had my 2 or 3 questions written down, and I went in, made an appointment with him, went in and talked to him, and he couldn't have been nicer. We talked for like half an hour, 40 minutes. He was super just generous with his time and kind and lots of comments. That was the first experience. And then the second experience was I wrote to my cousin, who at the time was I think she was either finishing graduate school or was a junior faculty member in economics at a school back east. And I said, hey, I'm thinking about majoring in economics. Tell me what your experience has been. What do you think? And she wrote back this long, like I want to say it was 3 or 4 pages, email talking about what she loved about it, giving some guidance and some help and stuff, and like suggestions for, you know, if you're thinking about graduate school, take this path instead of that path. And was super, like her effusiveness, her effusiveness and also Jim Curl's effusiveness were so just generous and kind, and it was cool to see people who were really excited about it. And so it kind of matched the energy that I was feeling, and that made me feel like maybe this was the right path. Incidentally, you know, my cousin was Bridget Madrian, who's now the dean of the business school at BYU, but at the time she was a junior faculty member, I think, or maybe just finishing graduate school. I can't remember exactly where that was, but
she's great. Jim's great. It's, you're not the first to have that experience with Jim Curl. You know, there's a couple professors, they're finance professors now over in the business school at BYU, but you know, they were econ. They were wanting to do something else and took Jim Curl's class, and it was like, nope, this is it. Like, he's funneled a lot. Well, he's enlightened or changed a lot of students' minds when it comes to econ.
Yeah, you've probably talked to you. I'll bet you have people that when they find out you're an econ major, there's a very dichotomized reaction to that principles class. For some people, I imagine you might have been in this camp. That's like the lights came on and it was this amazing experience. For a lot of people, that was the worst class they had in university. They hated it. And it really seems to be this thing of like, if your mind thinks in that way, then it just like, it seems like this is awesome. And if it doesn't, then it's terrible.
Yeah, that's tough. No, I had my high school econ professor or a teacher, high school econ. He was kind of like my Jim Curl. I'd moved from Ohio to Pennsylvania, and yeah, it was a similar experience. Like, you know, I'd read some things about econ, and I was like, well, what's going on? And like taking that class was totally like, it was my Jim Curl type experience.
Yeah.
So.
I had some later, you know, when I went to graduate school at Cornell. I took a class from David Easley, who ended up being my dissertation advisor. And it was on kind of information economics, which is a broad term, but the class was focused on kind of how do people use news and other information in changing their behavior. You know, how do they update their opinions or their beliefs about things, and in a few different settings. But one of the big settings where that is relevant, of course, is in financial markets, where the whole play of financial markets is thinking about, you know, or trying to make predictions about how assets will move in the future, or you know, what is the risk inherent in a particular asset, or the you know, expected return, and those kinds of things. And so I just really got that topic really became interesting to me. You know, although I study financial markets, like the thing that really kind of drives me or keeps me interested is human behavior. And so I mean, I enjoy financial markets. I think it's really fun, but one of the things I like the most about it is sort of thinking about how humans make choices, and humans, I mean, asset prices, the price of Google stock or real estate prices or whatever, are on some level a conglomeration of a bunch of individuals' choices about what they think will happen in the future, what they think policy will do, and all that. And that stuff is just really interesting to me. And so I got into that area mostly on the back of sort of that class, and just really enjoying the topics that were in it, and thinking about how humans deal with uncertainty and situations like that.
I one last point about econ and kind of like the getting a PhD is like, it's amazing how influential one or two people can be in your college journey as you start down the path. I mean, it's yeah, I think it makes all the difference. If you talk to a lot of like my peers who end up getting a PhD in econ, a lot of them are like, oh, this professor really like kind of, you know, pushed me to or not pushed me, but like really was influential, or like I did research for this professor. And it's interesting that you had a similar experience, because I think you being my professor is always kind of like, oh no, this is like, you don't always hear your journey of like how you got
Yeah.
from, well, being a student to being a professor. So
Yeah,
thanks.
they're humans too.
Yeah. Yeah, well, thanks for sharing that. So kind of switching gears a little bit, two things I wanted to talk about. One, financial markets. um, and I kind of wanted to ask you your opinion on, like, you know uh, markets are up really high. I mean, if you look, pandemic hit, they dropped, like, I think Dow Jones dropped to like 19,000. Now it's back up to 30,000. We're still kind of close. You see all these other financial assets kind of emerging, Bitcoin, and that price has shot up. Real estate here in Utah, that price has shot up. Uh, and now there's these new, they're called non-fungible tokens, which are basically digital assets. Like, they use like blockchain currency, and like prices for like video clips, or those assets, they've shot up as well. So like, what's going on in all these markets? It seems like everyone's just like playing around on Robinhood, day trading here. Like, what's going on?
That's a good question. So I think that's a very macro question. I don't know that there's necessarily a theme that connects all of these, but that is a fascinating thing. So we could take a couple of those kind of in sequence. The NFTs, the non-fungible tokens, is fascinating. And at first when you look at that, you're like, what? Why would someone pay? I just saw one yesterday. I can't remember if Jack Dorsey's tweet has already been purchased or if it's on the block or whatever. But and so Grimes issued a bunch of music that was sold by NFTs. At first blush, you're like, this is crazy, because everybody gets, if a musician creates a song, puts it on the Ethereum blockchain, and then sells it for whatever, $50,000 or $1 million or $12, whatever. That doesn't mean that I can't listen to it, even though somebody else bought it, right?
You can go on YouTube and watch these clips, or
yeah. Like anybody can listen to it, or look at the piece of digital art or whatever it is. So at first that feels crazy, but then you realize it's not that much different from like owning a Degas or a Monet, right? Like, lots of people can look at that. Like, if it were just about seeing the image, right? There are very faithful, high quality reproductions, prints of all of those famous, pieces of art. It's really just that, there is this reputation thing about owning it. So undoubtedly that's a hot area right now, and I'm sure that market will exist for a long time. I don't know if it will be as hot as it. I mean, I think eventually that will probably look like the market for fine art. Some people will pay $1 million. This was sort of this was predicted about, like, I want to say it's like 10, 12 years ago. Remember the Pharma Bro, how he bought that album from the Wu-Tang Clan for like $1 million? Yeah. And that was before, and I think it was Wu-Tang Clan, wasn't it? That was before NFTs, but it was kind of that idea of like, I'm going to sell this album to one person.
I remember.
NFTs, I guess, have the benefit that at the time, if that guy wanted to distribute the album to everybody, then everybody would have it. Now they can automatically do that. Everybody can buy the song or stream it or listen to it on YouTube. But one person gets to claim the rights that, like, this is my song, I own this.
That's true.
It's definitely a luxury market.
I definitely, I guess, as we were talking, the thought struck me. I guess this is kind of, I think economists would generally approve the technology underlining this market, the ownership, I mean, you're basically not distributing private property rights, but you're being able to carve out private property rights now,
Yeah.
which should lead to more efficient markets overall, right? If yeah, potentially, if you can define ownership, that should allow for markets to exist, should allow for efficient markets in some way, generally speaking. And that's
Yeah. So one of the real sort of values, the kind of persistent contributions of the blockchain technology is this idea that we can all externally confirm ownership of some object.
yeah,
And that's, I mean, that's the core of a system of money anyways, right? Like one of the things about paper money, for example, is that traditionally it's not trivial to counterfeit paper money. And because of that, that means that like when I own a $20 bill, everybody can easily verify that I own that $20. And so they know it's not going to get spent twice. Digitally, I think there's a lot of there was a lot of math that went into that. And I think there is value, that there is persistent value. I'm bullish on cryptocurrencies in general as a market class, as an asset class, in part because of this technology. There are a lot of them. There's over 1,000 cryptocurrencies. It doesn't take a prophet to predict that they will not all survive, but it, as a collective, I think it's a really interesting technology. It's also the case that they're potentially solving problems that were not unsolvable, but were being very slow to be solved. Like, why is it that clearing in asset markets traditionally has taken 3 days? Recently, it's moved to 1. They're moving to 1, but why doesn't this happen in 5 minutes?
yeah.
That is definitely something that feels like a legacy and a vested interest problem that should have been solved a long time ago, but has not been.
Yeah, there's having worked at a pretty big financial institution bank right after undergrad, there's definitely a lot of you think, and some of these institutions are pretty state of the art, but a lot of like the inner workings, the plumbing, so to speak, is pretty dated.
A little bit archaic, yeah. So I do a lot of work with financial market data, in particular order book data. So like the orders to buy and sell assets. And so I've done a lot of that with NASDAQ, New York Stock Exchange, BATS, Direct Edge, and also with some of these cryptocurrency exchanges, the new ones like Coinbase and Bitfinex and others. And their APIs, the APIs for these modern exchanges, the cryptocurrency exchanges, are like light years ahead of what's going on in the publicly traded like common stock markets like NYSE and NASDAQ. Like it is shocking to see the difference between them.
Yeah,
like they were written by computer programmers who, like contemporary computer programmers who know what they're doing. The APIs for the big exchanges they're very robust and they're time tested. But man, that's a complicated process to deal with the data that's associated with that.
Yeah, well, I mean, part of it I think maybe is regulation, right? A lot of these new exchanges that were able to operate kind of like out of the scope of the SEC and things like that. I mean, more and more they're starting to, but there's kind of this I don't want to say wild west, but it's kind of like, hey, like let's just make this really, really simple, really easy. Whereas like banks, I feel like a lot of times it's like, oh, well, we could do that, but we got to get approval here. Like it's just it's hard to do that because they're so regulated. And
yeah, I also think this is the standard story of just product development and evolution over time in general, right? Which is longer institutions that have been around a lot longer, you just build up this cruft where like for years and years you solve the problem by saying like, okay, we've already got this machine in place. What's the smallest thing we can do to kind of satisfy this new requirement? And pretty soon you end up with this Medusa that, you know,
It's hard to manage.
right. And a lot of these newer exchanges, the cryptocurrency exchanges, started completely fresh and just said, we know what we want after learning for decades from these more established exchanges. They could say, okay, we don't need all the other stuff. We just need this one narrow thing. And so they, you know, that's part of why innovators are often more nimble, you know, than the companies that have been around for a while.
Yeah, it kind of reminds me of, I mean, it's a little different, but kind of Innovator's Dilemma by Clayton Christensen, where it's like these, it's these cash cows, these stable businesses, like, you know, and I think, you know, I look at like the auto markets too, or, you know, the classic one was like rebar, steel rebar, whatever that Clayton talked about. But I look at like Ford and compare that to Tesla, and like, or all the major auto, you know, they do gas powered engines, and like for them to say, okay, we're going to go fully electric, like that's a costly proposition, you know, like there's this cash cow that they have, and they're like, wait, why are we, you know, versus Tesla is like, no, all we do is electric, we're new. And like it feels a little bit of a similar dynamic there as well.
Yeah. Ford is staring down the face of like, do we want to instantly depreciate billions of dollars worth of manufacturing equipment?
Right.
And you know, that's when it's bringing in revenue, you know, and
significant revenue too. Yeah.
Right.
Yeah. So okay, that was great. That was a good segment. I guess though, the, you know, when I was bringing up the, you know, these things about, well, I guess I also want to talk about technology, especially with information. We'll go there. We'll go there. We'll hold off on the inflation. I do want to cover inflation and your thoughts on it, but maybe we'll save that for last. Technology has changed a lot of financial markets, but it's also changed the information about financial markets as well. Like I remember, what was it, like a couple of years ago, 4 or 5 years ago? No, it was longer than that. Maybe it was 6 years ago. Reed Hastings put out a tweet about something about Netflix earnings before he like cleared it with the SEC, or like something like that happened. And like the people that were following him, like all of a sudden knew like, hey, Netflix is going to have a good quarter, and they were able to buy the stock before like the official Netflix earnings release or something like that. Fast forward a couple of years, you know, Elon Musk is tweeting like, hey, I'm taking Tesla private, and people are like, what? You know, like things like that. So I guess, you know, studying information, like how people make decisions, you know, I feel like the cost of communication has gone down dramatically through social media and other stuff. Like, what impact are you seeing, I guess, what impact are you seeing in the markets, and how you know, how does it affect like the individual, like consumer, I guess?
Yeah, so communication patterns are right. The 20, 30, 40, I mean, that's before my time, but years ago, when the sort of version of the Elon Musk tweet was like the way you communicated with all potential investors was you did your best to send out your newsletter, you know, to everybody, and you would mail it, but you just didn't have people's addresses. Now everybody has Elon Musk's address, right? If they want to listen to at least some of what he's thinking about. Or another way to say that is Elon Musk has everyone's address. He can communicate to literally everyone. You know, that what that's led to, as you alluded to, is that the SEC now sees, you know, the precedent has been established that tweets are a form of communication, and they can be monitored for, you know, inappropriate types of communication, misleading, fraudulent claims, you know, all of that stuff. At least if they're done with the potential intent of manipulating markets. So that's kind of a really interesting development that has the potential to make markets more efficient, because we all get access to some of these sources of information. Insider trading, which is a fact of financial markets. It has existed since financial markets existed. What that means is that it kind of goes underground. So it's not like the existence of Twitter eliminates inefficient, sort of informationally inefficient markets. But it does allow for, you might even argue that in some ways it allows for more manipulation of markets. Elon Musk's tweet being an example of this.
Right.
But it definitely for useful and good sort of reliable information sources, it's just much easier to get information now than it ever was. I mean, now there are hedge funds whose strategy is basically use natural language processing on tweets and Federal Reserve statements and other Wall Street Journal articles to just immediately, within milliseconds of publication, make a bet on what the publication of this article or this tweet or this Federal Reserve statement or whatever will do to a price. What that means is that probably decreases the ability of your average pajama day trader to, trade on that information. But, they're not perfect. So from taking classes from me that I'm not a big proponent of pajama day trading, but
I was going to ask what your thoughts on Robinhood, what do they call it? I can't say the word, democratic of finance or democracy of finance.
Democratization of finance.
Yeah.
Well, so Gamestop was a pump and dump scheme like any other. Yeah. It was a standard pump and dump scheme. What was innovative about it was the communication methods, right? So using Reddit to sort of organize these things. That harkens back to what we were talking about earlier, that like the Reddit people have everyone's address. If people want to go on there, and anyone who has interest knows how to sort of go on Wall Street Bets. But in terms of the financial side of it, there was nothing innovative about that, but there was some innovative kind of marketing, right? So pump and dump schemes are always a question of convincing someone else to get on board the train, and hopefully being able to get off. So the initiators of it want to get off before, they don't want to be the last one off the train.
Someone else is holding the bag at the end of the day.
Right.
Someone else is holding the tulip, is I think always the.
Yes, that's right. You believe someone else holding the tulip bulb. I think so what's sad about these whenever they come around is that I think it's frequently, it's the less experienced financial people that lose. So it's 20-year-olds who have not experienced or observed other pump and dump schemes and are like, oh no, they kind of believe the hype. Like this really is democratizing finance, and we're going to stick it to these. You notice the language that they use, and this is common to pump and dump schemes, the language that they use to communicate this is not language. It's partially language of like, you're going to make a ton of money, but a lot of this language was like kind of class warfare kind of language of like, the Wall Street rich guys, we're gonna punish them, which is not how you get the concept of It's a great investment opportunity. It's going to have really good returns relative to the risk involved.
Right.
Doesn't really get anyone out of bed in the morning. At least not standard non-finance people. It doesn't get them out of bed.
Right.
But the like, hey, we're fighting back against the oppressive power of these Wall Street finance people. That is going to pull in people that maybe traditionally would not participate in something like this. And sadly, some of those people that get pulled in that typically wouldn't participate, they're the ones who are not aware of these pump and dump schemes and how they could lose a lot of money.
Yeah. It was, I think it was an interesting, definitely interesting time. I think some people realize like, hey, this is just like, this is crazy, but I'm going to try and catch in while I can and then try and sell. But other people, other people are like, hey, this is going to the moon. Like, what? Why wouldn't this stop?
Right. I mean, the reality of financial markets is that they function. It's always a function of supply and demand.
Yep.
Right. If you can get a bunch of people to demand it, it doesn't matter if it's rational or whatever. Like, if a bunch of people want to buy this stock, the price will go up. That's always true. And sometimes through brilliant marketing and whatever innovations in communication, people can kind of untether those prices from what feels reasonable. And I mean, part of what hedge fund managers, mutual fund managers, and others that are active managers are doing is trying to look for those places where those prices get untethered. But yeah, it's I mean, supply and demand works. Sometimes that's understanding supply and demand will get you pump and dump schemes.
I think the rules, the principles of economics might not feel like they're always applying, but they're there. The underlying, they're there. So, kind of switching gears and kind of wrapping up here. Last question, last theme. So more on the politics side. Feel free to answer if you want, but. So the Senate and the House, I guess Congress just passed a 1.9 trillion bill, COVID relief bill is what they're terming it as. It's signed, I think Biden already signed it or he will sign it. Basically, there's going to be a lot more fiscal money, fiscal stimulus hitting America. So I kind of the theme that I've kind of been thinking about with, markets being really inflated, and now with this new bill being passed, is there pressure on inflation? Like, we really haven't seen inflation for the last decade. The worry really was more deflation after the financial crisis. And, there was a lot, Obama passed the stimulus bill. Trump blew out the fiscal debt. I mean, it just feels like there's really no limit to what the U.S. can print in terms of money, and like there doesn't seem to be inflation. Or is that just kind of, are we just kind of on the, to use the term pump and dump, it's not the same, but are we kind of on the rise up here and, no one's really seen hey, this could come back down to earth? Does that make sense?
Yeah, it does. So there's a couple of thoughts about this. First of all, Treasury rates and tips, the Treasury, the inflation protected securities are predicting, some inflation in the short term. It's looking transitory right now as of today. That can change. Inflation, as you know from that macro class, has a lot to do with is connected to people's beliefs about price. So if I'm someone who's setting the price for a company or deciding on pricing for a product that we offer, right? a lot of the inflation is sort of built into, if I think there will be inflation, then I will set my prices appropriately, and setting my prices appropriately actually leads to inflation. So so a lot of this has to do with expectations. The expectations right now, the best we can measure them, which is imperfectly, suggests that there will be more inflation, but that it will be transitory. Nothing like the late 70s, kind of inflation of that period. But
no stagflation where inflation.
Right. But higher than it has been. 2.5, high twos, maybe into threes. That's a possibility. You're right. The thing you alluded to, that monetary policy over the last, basically since the financial crisis of 2007, 8, 9, 10, monetary policy has been looser than most of our history. Like we've had a lot of asset purchases going on by the Federal Reserve, and we have not seen inflation. It has been very stable. One kind of hypothesis, which merits more significantly more testing, is you talked about all these new assets, right? So cryptocurrency, and cryptocurrency's market cap is on the order of $1.5 trillion. Their asset values have gone up. Home price values, especially in Utah, throughout the country, have gone up. One place where this extra infusion of money could be going is inflated asset values. And so if we were to, the potential for stagflation, which I don't see as a high risk, but the potential for stagflation would be if there was a generalized kind of asset decline, a big drop in confidence, especially in equity markets, cryptocurrency, real estate. If you saw that and people are pulling cash out of this, they're probably going to be storing it in banks, and if they're storing it in banks, if they were to, instead of storing it in banks, if they were to put it into, products and purchasing things, then you might see some generalized inflation that was even higher. But yeah, we have not seen a lot of inflation, but there is this, yields, as Treasury yields on the 10-year note have gone up a fair amount. They're still quite low by historical standards. Like they're as of recording, they're in the 1.5s or so, and that's still really, really low by historical standards. So even if they were to go up to 2% by the end of the year,
still pretty.
That's still quite low.
Yeah. I remember I did an internship at a trading money market desk last summer, and he was like, 2 years is, I forget how he said it. 2 years is driven by like the Fed. He said 10 years is investors' view on long-term economic growth. And traditionally economic growth, which would include inflation as part of that growth, has been around 3% for the US. And so,
yeah, a little south of that lately, but yeah.
Yeah. So just kind of interesting. It's well, I guess that's why that's why people get paid millions of dollars to kind of research, provide opinion, insights on like what they think markets are going to do, because it's not always clear like what's going on. Right? So
yeah, not this people, but yeah, other people do get paid a lot of money to do that.
Well, I think I see that was that the cap-in formula or the risk-free rate above the market.
Yes,
is that what's back there? I think so.
Yeah.
Well, Professor Condie, Scott, thank you so much for kind of sharing your perspective, coming on the podcast, discussing financial markets innovation. I guess any last thing you would say to the listeners, like one last thing advice or something you would say. Don't trade in your PJs kind of thing, or no?
Well, at your own peril, but this is really fun. What would I say? I don't know. That's a good question. Financially, one of the interesting phenomena that's going on in the country through COVID, and as we are starting to kind of inch out of that COVID period, is COVID has been pretty tough for the Gini coefficient, pretty tough for inequality in the country. People like you and I, we prior to the recording, we were talking about how our lives had changed a little bit in COVID and what was going on with work and stuff. It is definitely the case that sort of people with assets. So if you own a home, for example, housing markets are going really well right now. So people who own homes, who already own homes, are wealthier than they were previously. People in more white collar jobs, that although COVID was not easy for anyone, they in general kept their jobs and were able to work from home. People that were more in the service industry. So if you're a cook at a restaurant or a waiter, or you work at a comedy club or something like that, that's been harder. And so that's kind of an interesting, kind of very macro social question of what does that do to the economy moving forward, and does that put political pressure? Does that change the way that political parties talk to voters? As you see, on some level, that has the potential to exacerbate some of the things that led to Trump's election, was his ability to connect with these kind of otherwise economically disenfranchised voters. So it is a kind of curious question of kind of what that does, and how political parties make policy and start to communicate with those voters. That's a very economic question of like how people fared through the pandemic. But I think it will have really lasting, or potentially lasting, economic and also political and social kind of questions. I don't know the answers to them, but I'm curious to see what people figure out.
Well, it's that, honestly, that's something I don't think I've thought about enough about, and I don't think the U.S., the institutions, media, politicians have thought enough about too, is the potential blowback of, yeah, like you said, populism of like, hey, a lot of disenfranchised people who've had to suffer the worst of the lockdowns, the restrictions, where a lot of other people have kind of gotten wealthier because they're spending less money but still working, and
Yep.
it exacerbates the inequality. Maybe another future episode. So
yeah.
Awesome. Well, thanks Scott, really appreciate it.
Pleasure. Thanks, Matt.
Thanks again. Hopefully one of these days, I don't know, we'll run into each other again on campus. It was always fun. So
yeah, that'll be great. Good luck.
Yeah. Thanks. We'll see you.
See ya.